uh, uh, uh. Hello, hello. Hello, hello. If everyone could slowly start to take a seat, we're about to start. Thank you so much. We're about to start the show, so please take a seat. Thank you very much. Thank you very much. Nice, nice, nice. Thank you, thank you, thank you. Hey man, sorry. I should have introduced myself earlier.
Good. Hey, Peter.
Yeah, good to meet you as well. Hello, hello. We're about to start. Thank you so much. If you could slowly take a seat, that would be greatly appreciated. There's a lot to talk about, but you guys can talk later. Please approach your seat. All right, we're about to start in 1 minute. Thank you, thank you. Hey. All right, if you guys could all take a seat. Maybe there's not enough, but there's more seat in the back. So if you guys can take a quick seat, that would be great. We're about to start very, very soon. Thank you.
Cool. Nice.
I'm going to keep doing this until all of you are sad, so it's really up to you guys. All right. Cool, cool, cool. Grab a pizza, grab a drink.
Cool, good.
Please take a seat. All right. Okay. I'll give 30 more seconds for y'all to grab a pizza and take a seat. Okay, okay, okay. All right. Okay. You don't need to take photos. We have a photographer today. Thank you. Okay. All good? Oh, wow, okay. I'll just give you guys a couple more seconds. Cool. Okay, great. I'm going to start. Thank you very much. You're welcome. You're right on time, by the way. You made it. Thank you guys so much for coming. I would like to quickly start by introducing myself. My name is Tom Nakata. I'm one of the hosts today. I'm a co-founder and CEO of a startup called Qlay, and we're an end-to-end recruiting support startup. Essentially, I did a lot of recruiting work at McKinsey before this, and I wanted to turn it into a startup idea. And also, my co-founder is here today as well. He has a lot of interesting background from engineering to private equity to consulting. He'll be here during networking hours today. I just wanted to quickly, as host, introduce myself and what we do really quickly before we go into the content today. We do hiring platform for only vetted engineers. Think of something like Upwork or Fiverr, but everyone on there are engineers that we've already screened and interviewed for their particular skill set. I think the current engineering hiring process is a lot dependent on going on Upwork or going on Fiverr and then trying to figure out the types of engineers you need. But you still have to talk to each and every one of them, so it tends to take a little bit of time because you have to interview them and you have to make them do coding tests and things like that. But what we essentially do is we have an AI algorithm that's proprietary to us where we essentially do all this screening beforehand. So everyone on our platform is already done, already vetted. We tend to take top around 2-3% of all the applicants that apply for a certain position within our platform. So we're able to filter out all the interviews that end up becoming a waste of time for you. So that's our platform. If you are hiring engineers, please let us know. I'll be around all day. We also do a lot of these events in San Francisco and also Palo Alto. On June 17th, I think that's next week, we're also inviting experts from Amazon, Waymo, and also Intuit on how they use AI in their day-to-day work, as well as a lot of things that they research in. June 25th, we're inviting venture capitalists to talk about what kind of investments they tend to do on both the software side and the hardware side. We have guests from Samsung Catalyst as well as Micron Ventures. So they're actually experts in the hardware of AI investments. So think of like chips and things like that. So I think it would be a good change from all the software applications that there's a lot of events around. We also have two more. On June 26th, we're doing an event with Cloud AI, and also on June 30th, we're doing a startup pitch night with panelists like a partner from Alumni Ventures. So that would be something, if you're a startup, would be interesting to apply to. I have just one last slide before we go into. This is the last slide. This is a campaign that we're currently doing. If you are hiring engineers through a certain platform, if you book a demo with us in the next 48 hours, we're offering 400 engineering hours for free as a discount. The left QR code is the website where you can book a demo through, and the right side is my LinkedIn. So if you want to add me, please do that. I'm always free for a conversation or a chat. But without further ado, I would like to just go into the content. Let me pull up something here real quick. Okay, cool. So today we have the special honor of having Peter Walker, who is the head of insights at Carta. He focuses on cutting through private market noise with data-driven signal. Prior to Carta, he was the head of marketing at the media analytics company PublicRelay, and he has also helped create the data visualization team for the Atlantic Magazine's COVID tracking project. Thank you so much. Thank you so much, Peter. Everyone, please give a round of applause to Peter Walker.
Thanks, Tom. Switch it over.
All right. Here, let's take this out.
Yeah, no worries.
Where does this go into?
I got you.
Awesome. Thank you.
Yeah, no worries. Great. All right. Hey, everyone. My name is Peter. I run the insights team at Carta. Show of hands, who's familiar with Carta and what we do? Great. I can skip the first 10 slides then, no problem. No sales pitch for you tonight. Okay. AI fundraising. How many of you are building AI companies? How many of you are not building AI companies? Are you building companies that are just not using AI for some reason? Or are you just not building a company at all, not founders? Yeah. Okay, when I asked every single VC that I come in contact with in the Valley, and I meet dozens of them a week, what percentage of your companies are AI in some way, shape, or form? The percentage so far in 2025 has been 90%, but the percentage over the last 3 months has been 95%. So if you are not building an AI company, I think you're actually going to stand out. Good luck. It's going to be fun. If you are building an AI company, there's a lot of good data out there, but the biggest question that I think AI companies have to answer these days, especially if they're looking or exploring taking venture capital, is this one. How much capital do you really need? That's a deceptively difficult question to answer. It can seem as though the obvious pathway is to build, ignoring all the VCs, own all of your ownership yourself, give a little bit to your employees, but who needs VCs when you can build a profitable business that's scaling really quickly and running really fast? And that's a totally viable pathway. And then we run into founders who say, I want to raise as much capital as humanly possible because I don't know what the world's going to look like in 6 months. And it could be that this thing that I think is a rocket ship right now, I'm going to come on hard times and I'm going to need that capital to skate through to the other side. If any of you have founder friends who were founders in 2021 and then 2022 hits, or even better, late stage 2019 and then the pandemic hits, you know many of them wish they had more capital in the bank during those tough moments. So it's actually not an easy question. Before I get into this, yes, of course, all these slides are totally free. You can take pictures of them if you want to make me feel good, but you can also just email me. I'm happy to send you the deck. So it's peter.walker@carta.com. So context. It feels in this city like everyone is crushing it. I'm here to tell you that that is not true. This is venture capital raised by Carta companies every quarter. One of these years was a weird year. And it's not this year right now, okay? 2021 was an aberration. That we fundraised at wild amounts, at wild valuations, and I'd probably say that 2022, 2023 were hangover from that overfunding period. Now we're in a weird moment where we have both a downturn in general venture and an incredible boom in AI. And those two things are confusing the hell out of people when they look at metrics. So what does that mean for you as founders? If there's one thing to take away from the talk today, I think it's this. That green band is fundraising every 18 to 24 months. That is not reality anymore, right? The median amount of time between a Series A and a Series B in our data is 2.6 years at the moment. So when I talk to founders, I say, whatever you raise, could you make that money last 1,000 days? That should be your benchmark. Could I make this money last 1,000 days? And some of you are nodding and say, of course, I'm already profitable. I can make that money last forever. And some of you are shaking your heads and saying, no, there's no way I could do that. So this is probably, some of this change is because founders are choosing not to raise, yes, but a lot of it is because founders are finding that the metrics they need to raise their next round have gotten a lot harder over the last 2 years. So how many of you are VCs? I should have asked at the beginning. Okay, too many to talk truths. I'll pretend like you're not in the room. But what have venture capitalists been doing with their time and attention if, as we saw before, the fundraising for primary rounds is down? Well, it turns out, I think this actually speaks pretty well of VCs, they're spending a ton of time with the companies they've already invested into. Bridges, extensions, convertibles, a little bit more cash to keep those companies afloat. It's at record rates. 46% of all the seed rounds that you read about are actually bridges or extensions, not net new seed rounds. That's the highest it's ever been in the ecosystem. And that's because everything is changing underneath your feet so quickly. Of course, if you overfund companies in 21, then in 22 and 23 and 24, you're going to get a lot of down rounds. Highest percentage we've ever seen in down rounds. Those are still quite significant in the ecosystem, and they suck. They really suck as a founder, but they suck a lot less than closing down. So don't ignore a down round if you think you need one. It's actually becoming less stigmatized because 1 in 5 rounds are now down rounds. This is a typical chart to read this far away, but I'm going to make it a little easier. This is the percentage of companies that get from seed to Series A in 2 years or less, which is the standard benchmark. You're going to fundraise every 2 years, right? Well, in the boom times, 40% of companies did that. Everyone was graduating. More recently, it's 15% make it from seed to Series A in 2 years or less. So that suggests a couple things. One, you got to make that money last for a long time. And two, there's going to be a whole hell of a lot of companies that never make it past seed, or never make it past A, or never make it past B. People are getting stuck along the way. That's depressing, right? That's not that fun. However, you all are not building those companies. You're building AI companies. So we're going to get to the optimistic part. Okay, AI across stages. The orange bar is the AI portion. The black bar is everybody else. This is money raised last year for companies on Carta. Those are gigantic figures. If you put them as percentages, at least 25 to 30% of early stage and more like 50% of late stage capital is going to AI companies. This is an odd chart. It shouldn't look this way, right? Because AI is a new technology, so you would expect it to start at the earlier stages and then make its way up to the late stages. Not true for AI. Everyone has adopted this and started calling themselves an AI company. We can debate the definitions if you want to. But this is a tech change that is moving faster than any of the other waves that we've seen before. And yes, VCs are really excited about funding AI companies at exceedingly beautiful valuations for all of you, right? A 42% premium in valuation at seed stage. The median valuation for an AI company across last year was $18 million before you add in the cash. So more than 20 million once you add in the cash. That is historically very expensive. Incredibly expensive, actually. And the same is true for Series A. There's a premium. If I showed you this chart for Series B, Series C, it's all the same. Everyone is very excited about AI. Which begs the question, what is an AI company? What counts, right? All of you are probably pitching or considering pitching investors, and every single one of those investors is going to have a different definition of what they care about in terms of AI. Some of them will only invest if you're building your own models. Some of them will only invest if you have proprietary data to fine-tune your model. Some of them will invest if you're calling ChatGPT in the right ways, right? There is no set definition of what is defensible in this AI wave, and it's screwing with people's heads. And by people, I mean the VCs, because they've looked at some companies that are growing really quickly, and then a year later, they've lost 40% of their revenue, 50% of their revenue, because they didn't keep up. So when you wonder why VCs are sitting on their hands when it seems like there's such amazing companies out there, it's because they don't really know whether or not it's going to stick, right? The defensibility is really, really difficult right now. On the plus side, you're probably not going to sell quite as much of your business. So if you're selling equity in your rounds, it's about 20% of your company in the seed round, 20% in your Series A, and then on down the line. The orange bubble is the AI companies. You're selling a little bit less than the other people. AI is everywhere, but if you were to treat it its own thing, it's obviously up and to the right. Some industries VCs are not excited about. That's lower left. Some industries they are more excited about. That's upper right. If you're building in DTC retail, ed tech, or personal products, that has been a consistent theme over the last year or so. Really tough to find venture investors who care about your sectors right now. Sorry to say. And everybody knows we're in the heart of the AI wave right here in San Francisco. The Bay Area accounts for about half of all the money in AI companies until you get to late stage, and then it's 3/4. So if you are building an AI company, you're playing in the center of the NFL right here. All right, last part. The big changes in company building. We can talk about fundraising and valuations all day, but I think this is the number one change that's happened to startups over the last 2 years. Apologies, Qlay. You stopped hiring people. The black line is new hires across Carta. 70,000 in January 2022, 32,000 in January 2024, and that number for January 2025 is going to come in at about 20,000. Massive shift. And so what does that mean? On the earliest side, what it means is founders are building with just the founding team for longer than they ever have. So this is days from incorporation to the day they make that first hire, or the second hire, or the third hire. So founding teams just building together, obviously most of them using AI, sticking around just us as founders for a long time. The second impact, on through the stages, all of these companies are smaller than they used to be. So in 2022, if you raised the Series A, you probably had 20, 21, 22 employees. Now you have 15. By the end of the year, you'll have 12. That's the average number. Small teams moving really quickly. That is definitely the new way of building startups, and it's being driven for good reasons, obviously. It's lovely to have a capital-efficient business, and because the VCs are very, very interested in everyone's favorite new metric, which is ARR per FTE. A lot of startups are trying to get to over $1 million of ARR per FTE. That's their new mark. Not as many are hitting it as say they are, but it is what they're shooting for. And we'll end by saying, oh, I guess not. Nope, that just go away somewhere. Don't know why that happened. Sorry, y'all. Okay. When you do end up hiring people, at the beginning at least, these grants have gone up a little bit over time. So the earliest employees are receiving a little bit more of the company than they used to, but it's still not a crazy amount. I mean, 1.5% for the first non-founder at a startup. How many of you would join a startup for 1.5% of the company as the first hire? Yeah, I agree. Probably not enough. You can see that the range is very wide, right? Sometimes it's 1%, sometimes it's 4%. It's kind of all over the place. But in general, I think that there's been a trend for early hires to get a little bit more equity than they used to. And then we come to your ownership, which is where we'll wrap up. How much of your company will you own after every round? So the orange bar here is the founders as a group. After the Series A, the median amount of equity over the last 4 years or so that founders own is 36%. I don't know where the idea that you need to own half of your company after the Series A came from. I'm here to tell you 8 out of 10 businesses on Carta do not make that mark. Now, is that money worth it to you? It gets back to our very first question, right? This is a ton of dilution. Look how quickly those things go down. If you want to play at the very biggest companies, you probably do need some capital, but is it worth this amount of dilution? It is the number one question that founders like you are asking yourselves. Is there a different way to build? Can I take 1 round and be done? Or maybe 2 rounds and be done? A lot of companies are trying that pathway right now. Too early to tell whether or not that new mode of company building is super sustainable if you want to be an IPO. But hey, if you want to build a great business that can be a life-changing outcome for you, your family, and some employees, probably venture dilution is not in your future. So you got to know which game you're playing. And we'll end right here on the CEO ownership. How many of you are CEOs? Cool. This is for you then. How much of your companies do you own over time? Obviously, it matters quite a lot how many founders you have in the team at the beginning, although these numbers converge pretty tightly by the end. So 7 to 10% of your company at Series D. Not so bad, right? Dario at Anthropic owns about 2% of his company. I know it's maybe a silly illustration because there are 7 co-founders and he's worth $60 billion. A little bit different. But dilution can sneak up on you. Don't let it happen. And be very, very careful about the money you raise. I know we have a talk in a second, but any questions as I'm standing up here? Any questions about our fundraising data or things we can talk about at the market? Yeah. Can you shout it out?
2 questions. One,
Oh, amazing.
2 questions. One, hiring, was that specifically for SF or worldwide?
Across the US.
And,
Yep.
the other question was, I saw that the employee pool was growing as we go through the funding series.
Yep.
So are companies just growing their pools?
So yeah, they're utilizing a little bit less of their pools than they used to, which is a little odd to me.
Percentage is growing in the pool.
So what happens is you start your pool at 8 to 10%, generally speaking. If a VC, by the way, tells you to start at 20, tell them no. There's no need to reserve 20% of your equity for employees at the very beginning. Start at 8 or 10, and then every time you fundraise, it grows a little bit as you need new hires. The weird dynamic, though, which I'm sure you're just pointing out, is if I'm not going to hire that much, why do I keep growing the pool? I honestly don't know why the pool continues to grow at this point for some of these companies. Maybe they just want optionality or having some reserves, but the utilization rate of that pool is going down. So there's just more equity being reserved and unallocated to employees at the moment.
And also, there was a 54% equity ownership for single solo founders.
Price seed. So after oh, one more?
Yeah, 54% the price seeds for single founders.
Yes.
So they're just giving up 50% of the company at seed stage.
Well, if you raise a pre-seed for 10%, a seed round for 20%, and you have a 10% pool or a 15% pool, it adds up pretty quick. So that is after your seed round, right? So that's including the round you raised. Which begs a question. People are doing crazy stuff on safes these days, y'all. Like, don't stop raising 8 rounds of safes. It's not good for you. It's not good for your business. It feels easy and simple. It's dumb. Don't do it. There are companies on Carta that have raised at 30 different valuation caps on safes. That is not being cheap and frugal. That is kicking the can for a gigantic legal bill down the road. So I would say safes are great for 1 or 2 rounds getting started, but people are overusing them a lot right now. Cap safes. Uncapped safes, great, but those are from your parents. They don't really exist in the real world. Yeah. Yeah. Thank you.
But the question is, you're talking about the employee pool and the percentage increases as you go through the different rounds.
Yes.
So we've already set up percentage that you haven't had a price round yet.
Yep.
Can you change the pool?
You sure can. You can do whatever you want with the pool, really, before you start pricing the rounds. The VCs are typically of the opinion that you should make the pool a little larger, but that's because they would like to dilute you, not themselves, typically in it. So just have a plan for who you're hiring and see how much equity you need, and if you can stick to that plan, all the better. Yeah. Other questions?
Just a previous point, which I mentioned multiple safe caps.
Yeah.
So can a founder have two or maybe more than 2 different safe caps and provide to investors based on what value they're liberating along the timeline?
Yes, you can do that. A lot of founders, there are 2 ways to raise on safes that we're seeing in the market. The first is, I'm going to raise, like, let's say a pre-seed round, I'm going to raise $1 million on a 10 million cap safe. You do that, you stop raising, you build, and then you say, I'm going to raise a seed on safes. That's going to be for a 15 or a 20 million cap and for a bigger amount of money. So 2 basically separate raises, even though they're both on safes. The other strategy that people are doing, which I don't agree with, is I'm going to do a tranched raise. So I'm going to go to an investor and say, if you give me money this week, it's a 10 million cap. But if you give me money next week, it's an 11 million cap, because this thing is hot. It's going fast. When it works, it works. And when you have to go back to the investor and say, actually, special discount, it's still 10 million, good luck. So you're boxing yourself into a corner, and you better be right when you do that. Yeah. Yeah. Maybe one more, and then we're going to get into a panel. And we'll have time for questions at the end, I'm sure. Yeah.
So you mentioned at the beginning of the talk that AI companies recently represents between 90 and 5% of the employees or VCs?
90 to 95% of the companies that they are seeing today.
Okay.
So the meetings that they're having, yeah.
Okay, because I just wanted to have a sense if it's like 90 to 95, but then there was one slide you said that the total capital raised by AI was somewhere close to like 25%?
Yeah, 25 at the earliest and 50 at the latest. I agree. When I talk about the VCs that I'm meeting, most of them are here in San Francisco. There's a much higher percentage of AI companies here than anywhere else. That's one. And 2, I agree with you. They say they're meeting only AI companies, and yet the data doesn't quite look the same. So maybe they're either lying to me, which hurts, or there's a lot of deals that are not quite AI and maybe have a little AI component that they're not counting. But yeah, it is a little odd, right? Yeah. All right, y'all. Thank you so much. We're going to get into a talk. Oh, wait, I should explain these, right? I have QR codes, but that's Carta. It's for free until you raise $1 million. That's awesome. If you're on Carta, new thing from us. That's the left side. On Carta. If you are raising a priced round, we want to help you save money on lawyers, right? The reason that you probably don't want to raise a priced round is because legal fees are super high. Let us do some of the admin work for you for free with this new deal closings product, and don't pay paralegals to send documents back and forth. So, thank you so much.
Should we do like a quick photo?
Yeah, we can. Yeah. Wait, are we doing a talk? We are doing a talk, right? We're doing a talk. Are you interviewing someone? Yeah. Okay, cool. Are you doing a photo as well?
A quick photo.
All right.
Joker can come up here.
Everyone gets to watch us take a photo. Enjoy it.
Just really quickly. All right, look at me. Thank you. Stay there. Ready, 3, 2, 1. Hold the shot. One more. Ready, 3, 2, 1. Thank you so much.
Thank you.
Thank you.
All right, talk.
Up next, we have a panelist joining today. And we have Milly Wang, Vice President from a 65 Equity Partners, a global investment firm that's backed by Temasek. And it has a $3.3 billion in funds under management. She previously worked in private equity at Carrick Capital and as an investment banking analyst at JP Morgan. If you want to come up to the stage, Milly Wang, that would be great. And if you could hand her a mic. I'm actually going to do that.
All right. Okay. Yeah, let me do that. Sorry. Cool. I'll do it. Sorry about that. Thank you.
Stick this somewhere.
Is this, sorry.
Sorry, we have some.
Does that work?
Does that work? Milly, can you check?
Hello? Hello? I think it works.
All right.
All right.
Cool. Everyone, please give a round of applause to Milly Wang, please. Thank you. Okay. Well, thank you so much for being here with us, Milly.
Thanks for having me.
Maybe you could do a quick intro of yourself so that everyone gets to know who you are.
Sure. Happy to. So, as Tom said, I work at 65 Equity Partners. We're a global fund with $3.5 billion AUM, so offices in Singapore, London, New York, and San Francisco. Mandate is pretty broad. We invest in everything other than real estate and oil and gas. And in terms of types of companies we look for, generally a little bit more later stage, but very much companies that have what we consider very passionate founders who still are passionate about continuing to run their business. That's one of the key things that we really look for in our portfolio companies. Yeah.
Maybe, do you have any interesting thing that you picked up from Peter's presentation? Anything that you found interesting? Anything that was surprising to you?
I do think Peter had a lot of truth about, as a founder, you should know what you want as opposed to what a VC will ask you to do. Because most times, I think to his point about the employee pool, it is true that VCs would generally like to have a larger pool because a lot of times dilution comes at the cost of the company itself. And so if you are fundraising, it's important for you to have an idea of exactly what you'd like and to stick to it. I also think it's very true that it's a balance between generating hype and actually being able to back it up, right? And so while there's techniques that founders will do to really generate, hype, a sense of scarcity, which actually works very well for VCs. But if the round goes sideways, then it is actually very tricky for you to really get it back. If you have to go back to VCs and say, oh, actually, we have room, or actually, we're lowering sort of the valuation. And so I think, and ultimately it comes down to being able to demonstrate there's traction, being able to actually have a product. And if you have all those components, and I guess not to be super greedy was the raise, right? Being reasonable, closing around faster, I think is a lot more valuable than optimizing for a round, because a lot of times it's important to just really focus on building. When you're fundraising, you're not really focused on building and growing. And all the little sub-optimizations don't really matter in the grand scheme of things.
I think a keyword that popped up was a hype around AI startups. And I think as a capitalist, you see that often. And I'm sure, a lot of you guys have seen AI startups that aren't exactly defensible, but there's a lot of hype around the AI, what it can do, what it can't do. So I wanted to ask, how do you assess the actual technical depth of AI startups? How do you assess defensibilities? What are some indicators or proxies that you see from startups that indicate that they're a real business rather than a hype startup?
Yeah, I think you can come at this from a lot of different angles. It really depends on the stage of the business, right? The more later stage a company is, you'll be able to see, does it have traction with customers, right? Is there a product market fit? If you're looking very early stage, a lot of times you'll have to look for, I guess, ancillary indicators, right? And so most of the time, if there isn't revenue, if there isn't really a product yet, you'll look at the team and you'll look at team background, right? This is a reason why a lot of earlier stage VCs like to back repeat founders, because if you have that track record, if you've done this before, it gives you a little bit more legitimacy. And it also gives you sort of like a network and connections that you can tap into when you build your next startup. If you come from well-known AI startups, if that's your experience, that's your background, if you were a software engineer there, that helps because it is another layer of external validation in some ways. What's also very valuable is your ability to really attract talent. And so if you're earlier stage, you're building out your founding team, if you're able to hire high caliber talent, it's actually a very good external indicator, right? Because when you hire, at least for your early teams, it's a two-way evaluation anyways, right? As you're evaluating them, they're also evaluating you, evaluating your product, your direction, your capability to really lead the team and grow the business. And so if you're able to hire some very strong, founding members with technical skills, I think it's a good sign that you actually have something there.
How many, I guess in that regard, how many of you in the audience are repeat founders? Like anyone who's founded a startup before? Okay, we have one over here. Everyone go talk to them after. Okay, so we have a couple actually. Okay, that's actually a good sign. Okay, cool. I guess in that regard, how many of you guys are doing an AI startup? Like among those who just raised their hand, are all of you guys in somewhat in AI space? Okay, so a lot of people are in the AI space. But when we say AI space, I think a lot of people would think of applications like an AI software or like maybe an infrastructure. People don't really think about hardware. I think there's a lot of different pieces of what happens in AI. But yeah, that too, that's a huge one. Cybersecurity is a huge one. Infrastructure, and I think there's a lot of things. But is there like any specific portions of an AI field that you're specifically, very bullish on? Any layer that you're a little, weak about? What's your take on that?
Yeah, so I think I'll answer this in two ways, which is areas that I think is interesting and areas that we as a fund can feasibly invest in. Because I think personally, I would think there's areas that are very interesting, but as a fund mandate, we don't really touch. And part of that, it could be sort of like level of investment. Part of that is just fund expertise. I guess actually maybe one point to add to the prior question that I just thought of is I think a lot of times VCs are more generalists than they are specialists, unfortunately, right? And so a lot of times they'll get into hype deals because they're too scared to ask questions that makes them seem like they don't know what they're talking about. So I do think, to be a good VC, sometimes you do have to admit when you're out of your depth. And when you're talking to companies, I think even if you think it's a dumb question, you should still ask the question. Because a lot of times you'll find that when you ask basic questions or you ask about the technology and you ask them to explain it to you, you'll find that the founder themselves can't do it. Either because it's a wrapper on ChatGPT and they can't actually talk about sort of the infrastructure and the underlying layers, even though they said they built it. I think a lot of times VCs are too scared to ask the questions because they don't know the right questions to ask or they think it's a very basic question. But I think the best ones who are able to really identify, is there a solid technology? Is there something there? Will ask all the basic questions and see how the founders respond to that, right? So in terms of areas I think is interesting, I actually do think in terms of infrastructure, chips is very interesting as a space. Just because if you take a step back and you look at the big picture, the ability to do things cheaply, to do things quickly is going to be contingent on that hardware piece. Unfortunately, and this is where I say there's a difference between what we can invest in versus what I think is interesting. We don't do any hardware as a fund. And you'll run into a lot of VCs in this situation. There's going to be specialist VCs who are more deep tech, can invest in the hardware piece. And if you are building a hardware product, it's important to really target VCs that do that. Versus a lot of more other VCs will just, they may look at your company, but as part of their mandate, it's very tough for them to do a hardware deal because it's very capital intensive, right? Most VCs, I think, would look at more sort of the mid-layer and look at more the application. And I think similarly for us, we tend to look at more application types. In terms of within the application, I think there's a differentiation between more horizontal tooling, which we actually think is a little more commoditized. It's versus verticalized. We actually really like verticalized solutions because a lot of times, and maybe it's because we also look at companies that tend to be a little more later stage, but with verticalized solutions, it's actually just the next layer progression from data analytics is the way we see it. And so you'll have moats that a lot of verticalized companies will have. For example, in healthcare, there's a lot of regulations in healthcare where if you're building in this space and you're building an AI tool, you'll benefit from similar moats such as HIPAA, such as inefficiencies between health plans, value-based care, reimbursement, et cetera. So there's a lot of plays there. Or if you're building in serving financial services, there's a lot of regulations there, whether it's related to FINRA, whether it's related to banks having to hold a certain amount of capital, whether it's insurance companies having to manage reserves or risks, or KYC, AML. These are all sort of sub-vertical, sub-areas that have inherent moat and a lot of incumbents that haven't really leveraged AI, is very slow to adoption, that we think is very interesting because if you develop tools and technologies in this space, it sets you up very well to really take share. It sets up you well for a potential exit to a strategic, or it sets you up well to eventually be a large player in this place that could go public.
I think I want to drill down a little bit on what you said about potential exits. So, Milly mentioned something about if you're more of a verticalized AI company that helps you build a more, or I guess, because you're verticalized, you have more of a tendency to have a stronger moat, and that protects you, building up more possibility for an exit, which we all like to do. But are we actually seeing exit potential for the current wave of AI startups right now? Because I think every month we always see different startups, but we never hear about, that massive AI startup got acquired. I mean, I guess we've heard a couple, but it's not like a thingy just yet. We see startups getting founded and killed, but we don't really hear about AI startups exiting often yet. Are we starting to see a clear path for an exit for this batch of AI startups, or do you think that's kind of still in the gray zone?
I think it's still a little bit hard to tell because, your ability, I guess it depends if you're thinking about exit as a potential sale or an exit as an IPO. Right, because I would say at least currently the IPO market is still relatively tough. It's been tough for the past 3 or 4 years. I think 4 or 5 years ago when we were looking at the market, it actually was really good for us because the IPO window was closed for a lot of really late stage large companies that were doing well. And so opportunistically, because we invest across the capital stack, right, from very early stage to very late stage, it served our purpose in terms of really opportunistically looking at putting capital into companies that couldn't IPO but needed some sort of additional capital for growth or some liquidity. I think now it's recovered a little bit, but if you're thinking about an exit in the IPO market for AI companies, for pure play AI, I think it's further down the road, right? I think it'll come after a lot of the AI adjacent companies IPOing, right? And so once that wave starts, because ultimately those are the companies that tend to already be of scale, have really strong organic revenue growth, as well as a lot of them are profitable, right? There's going to be, I think, as the IPO market heats up, companies that are not profitable that's going to be able to IPO as long as you show really strong top line growth. But in terms of the M&A market, I actually think there is a lot of opportunity right now for M&A because there's a lot of large players who are looking to add to their portfolio of products. However, the current economy is a little bit uncertain, so it comes down to cash flow and profitability, right? And so when there is an improvement in sort of overall cash flows in potential acquirers, that's when they'll start looking into the market for M&A activity. So I don't think it's like a this year, next year thing, but I definitely think within the next 5 years, there's going to be a lot of exit potential.
When you do a startup and hear news about Codium getting a $3 billion or potentially getting a $3 billion exit, you get really excited, but it hasn't happened yet.
Yeah, it's
We'll
not to
see
say
how
it
goes.
wouldn't.
Maybe a little bit on risks of the current AI investment. There's obviously regulation. There's obviously compute scarcity. There's obviously talent and where they are. There's a lot of risk factors in the current AI development and startup culture. What do you, if there is any risks to the current wave of AI startups being founded, what would you expect is a big one that could potentially hurt these AI startups? Like, what do you think AI startups should be worried about? What do you think founders should be, having nightmares about?
I think in general, founders always have nightmares, but I think that's what keeps them, I guess, at their peak. Well, I wouldn't say there's sort of any one thing, or at least, off the top of my head, I can't really think of any one thing that's potential like a boogeyman scenario. Like even if there is regulations, there's regulations everywhere, right? So I feel like part of startups is being nimble and being able to work around sort of regulation hurdles. And if you're building, it's important to be good at pivoting. No matter which stage of startups you are, I actually think the most successful startup founders are those who can pivot the quickest. And if you haven't found a product that is growing really quickly, even if it's painful, sometimes you should just pivot. And I think the right kind of founders know when to cut losses, when to pivot, when to go into the right direction, right? So I feel like things with regulations is not really a hurdle because the right kind of founders are able to actually leverage that to find an area they can grow in, which others may struggle to grow in. I do think compute power, you may hit sort of like a limitation there, which is tricky. With that said, though, I don't think, at least for us, we don't really see models as an interesting area. We're not bullish on models. We think it's very commoditized, right? And so I think if you are looking at, to your point about hiring talent, I actually think what Peter said earlier about now there's less of a need to really hire is really interesting. Right? Because previously it's true, if you're building in specific spaces, you may actually run out of key talent to hire. Here, it's not really you run out of bodies, but you may run out of the really good ones. And so it is still a competition for talent, but not in the sense of, you may just not have enough engineers that you can hire. It's sort of like you're not looking to hire 10 engineers now. You might only be looking to hire one. And the question is, can you find the engineer for one? But now I feel like there's also tools out there, depending on what you're building, right? Where you no longer need to hire actually the top engineer to do what you want. You might be able to hire an engineer that might be 10th on your list, and that would be okay because there's all these AI tools that can support what that engineer needs to build and do.
That's actually a really good point. I actually want to, just one more question before I hand it over to the audience. You mentioned pivoting, obviously a huge topic among startups. One successful story about, a pivot success story is around how Slack was doing something else, initially, and Slack was more of like an internal tool that they were kind of building on the side, turned out to be a home run, and obviously now is their main thing. But obviously there are stories of success with pivots. Are there other, like what kind of pivots do you tend to think is a good idea, or like based on historical pivoting trends? Like what are some pivots that you think was a really good move? Or is it just kind of the characteristics of a founder who's good at pivoting that's more of an indicator of a startup success?
As a general rule, you should always follow the customer. I think that is a general rule. The question is, who is your customer? And that is, so I think there's various different ways that founders go about building a startup. Some founders are like, I just want to solve this problem, and that's what I really want to force into existence, and that's okay, right? Versus some founders are like, I want to serve this general area. And within that, you basically need to find who's your right customer. So the first customer you start with may not be the right customer for you and what you want to build ultimately, right? But I think you can never go wrong with following the customer and what the customer needs. I think the right kind of pivots are pivots that continue to build differentiation in your product, right? Because you're always trying to, and like I think to sort of an earlier question, one of the ways you really want to differentiate is actually having, and this is one of the things that Peter mentioned, is like, what are VCs really looking for to be able to identify, is a company differentiated? I actually think out of the three he's mentioned, having proprietary data is something that we've personally found to be very valuable, right? If you have proprietary data, not necessarily to train your models, but in a vertical SaaS context, you have something that other people don't have access to, and that's something that is very valuable over time. And so as you're pivoting, you should be thinking about, how do I pivot and build something that's proprietary, whether it's data over time that I've gathered through all these different types of pivots, right? I don't think any sort of pivot is like a pivot that's gone to waste for a good founder, right? But at the same time, I mean, and I'm going to sound a little wishy-washy here, but I've also seen founders who are very good at cutting things that are good but not good enough. So I think a lot of founders fall into the mentality where they're like, oh, like this is I'm making revenue, I'm generating revenue, I've got some customers, there is some potential here, right? But actually, I found some really great founders who will look at it and said, look, I'm generating $2 million revenue here, but I don't think this is a $100 million potential business line. And I think they are ruthless in how they optimize and prioritize focus areas. And they'll say, look, this is generating revenue. Is this worth my time? Or should I cut this off now and really find or build in this product opportunity that is, I think, $100 million opportunity potential? But to your point, like there's also the Slack example where there's founders that just stumble upon an opportunity that fits really well with the customer. And that falls into the first category of like following where your customers want. And you may accidentally, hit the jackpot in something that you don't realize. Yeah. But if you're trying to take a very methodical approach to it, I actually think you have to be very ruthless with being able to identify what you think has the market size you want to go after, and being able to cut out business lines that might still be bringing in revenue.
Ruthless. Okay. Maybe, all right, do you just want to shout it out?
Yeah. Many VCs are right now hesitant in investing in AI companies because it's changing so fast. So the question is, like, what is your length of your like expectations, like you want to stay with the company to get to an exit, like 3, 5, 7 years, And how do you decide on founder problem fit? So then ensuring that your investment will be a good investment, that you considering the length of the time this investment will be like 3, 5, 7 years. Then when you get money back, but the market will change so drastically with AI, even in a year from now. So when you get to an exit, it will be a completely different world. How do you know that this team will be one?
Yeah, I think overall, VCs in this current environment are a little slow or hesitant to invest, in part also because the VC fundraising environment has been slow, right? So for a lot of VCs have actually struggled to raise funds. And so in some ways, it's been good for us because we're not fundraising. We actually our fund was raised in 2022. So if anything, there's a lot of dry powder still there. But I do know within the general investing space, there has been a slowdown potentially in the volume of deployment. However, that's not to say there's a slowdown in valuation, because ultimately investors need to deploy capital. Now there's just going to be a flight towards quality, right? And so if there is a really great startup and everyone still wants in, you can still command really high valuations. It's just that previously, when there's a lot of capital floating around, companies that may not have been sort of like top tier would get a second look from a lot of VCs. Now it's a little tougher to do that. And because it's tougher as a general fundraising environment, VCs are also slowing down and really trying to think about what is the startup that they can invest in and stay in for 5 to 7 years. So our whole cycle is 5 to 7 years, right? Because in a frothy market, you don't really have to think about 5 to 7 years, because you can get out when they raise the next round. You can decide what to do, sort of like liquidity-wise, et cetera. But when liquidity is a little bit slow, you do have to start thinking a lot more about what is a company I can stay in for up to 7 years if I have to, right? Sorry, your part of your question was what?
And what are the patterns of like a team of the founders that
Yeah.
will convince you that this is the one versus all these other 95% of AI companies being in Silicon Valley or wherever, trying to do something?
I think to my earlier point, right, it comes down to, do we believe that the founder has what it takes to build this? A lot of AI, to I think Peter's earlier point, like a lot of founding teams can now scale and grow businesses without having to hire a lot more people. You can do it with a founding team. And so, but you can only do it as a founding team if the team has the right technical capabilities, also the right sort of customer relationship. So for example, if we're looking at like a SaaS or an enterprise software or enterprise AI business, a lot of times you'll have to see if they have the right relationships, because sales cycles in these places, one, is really difficult to get in front of your customers. 2, sales cycles can be 18 to 24 months, right? And so you have to know, is this the right team that has the right connections, can build the actual product for this? For a lot of consumer-based products, right, that's less of an issue because it's easier to get in front of customers. However, right, your contracts are smaller, right? You're not locking them in for a certain amount of period of time. So there's trade-offs on both sides, but depending on the subsector you're in, depending on the product that you're building, we will look and evaluate, is this the right founding team that has the right background to do what they say they do? And then secondly, it's like, is this product interesting? And this goes down to my earlier point of like, you have to really ask the right questions to really understand, right, does this team, has they built something truly special, or is it actually something pretty easy for someone else to just replicate, right? Is this a team? And sometimes the product doesn't have to be super, I guess you don't have to build your own model. I actually don't think, one of Peter's points is like, I don't think you have to build your own model as long as you have a different edge. And maybe that edge is the customer relationships you have in the industry. Maybe that edge is the data that you have, not necessarily the model, but you need to be able to demonstrate a certain level of edge in that space that you're building.
Thank you, appreciate it.
Maybe we'll take
Maybe we'll take one more. Oh, over there. Thank you.
Thanks, Milly, for sharing. I noticed there's a recent trend as you invest in later stage startups. You probably interact with PE firms a lot, and recently there are a lot of VCs trying to invest in like roll-ups, which is traditionally a PE play. So I'm curious about your take. Like, why is that happening? Like, VCs seem to be very in the line with PE, and what does it mean for founders who are doing those roll-ups? Are they more like operators hired by the PE firms, or they're still like startup founders?
Thank you so much for asking that question. I wanted to ask that question too.
Sorry, just so I want to make sure I've heard it. The question is why, I guess there's the recent trend of VCs wanting to now invest in roll-up strategies, which is traditional private equity. What was the I didn't hear the second part of the question.
Yeah, what does it mean for the founders? Are they more like employees, operators hired by the PE firms? So they own much less share. I heard the VC would take like 60-70% in Series A round to do those roll-ups. So yeah, I'm wondering what does that mean to startup founders who are doing roll-ups?
Yeah, so I actually don't think there's a very strict delineation between what is VC and what is PE at some point, because as a capital allocator, it's all a spectrum, right? And so at some point you're going to converge, because if you look at the capital funding environment like 2 decades ago, it's actually everyone's like very early, you're either very early stage like a VC, or you're very late stage, which is private equity. And then over time, it's really blended together. As VCs continue to, in so words, like reinvest in the companies as they continue to grow, they've developed more growth-like late stage funds. And then private equity, who's seen the benefits of investing in smaller businesses, more earlier stage businesses, has also moved sort of downstream, right? So there's a little bit of convergence effect happening in the middle where there isn't really a clear delineation between private equity and VC. Everyone's chasing where the opportunity is. And I think that's also why a lot of VC funds have looked at roll-ups, because roll-ups historically have been very, very profitable strategy. Roll-ups, though, I would say, is a strategy that works well in a bull market, because what you are essentially hinging the strategy on is multiple arbitrage, right? It's the idea of I am acquiring these small companies at a much cheaper valuation. When they join and become part of my larger platform, this platform as a whole has a premium to it, right? And so it has a much larger valuation. So essentially it's an arbitrage of value that by acquiring, I immediately get a multiple effect on the businesses I acquire. And I think that it is a good strategy depending on the subsector you're in. So in insurance, there's a lot of roll-up opportunities. In healthcare services, there's a lot of roll-up opportunities. And we've looked at both areas and continue to be very interested in both areas because there is a lot of potential there. If you're talking about where the founder comes into play, it doesn't really matter if it's a VC or if it's a private equity. It matters which PE fund or which VC fund you take on as a partner. Because I think ultimately everyone's different in how they partner with founders. There's going to be funds out there that have a very strict philosophy around here's the playbook that we have. When we invest in a company, here's what we expect the founders to do because this is what we think works. And we have a very strict playbook that we expect you to do X, Y, and Z, right? Build out your executive team to do this, have your M&A business development team to do roll-up strategy this way, have your sales and marketing team this way, have your ops team this way, right? There are funds out there that are very founder-friendly, where they will back a founder saying, look, you've done this. We think you're capable of doing it. We've seen that you've had historical success, so we're going to trust that you have what it takes to make it work. We're not going to be prescriptive because we think every company is unique, and we're investing in you because we think you're special in a certain way, and so we're not going to tell you what to do. And so as a founder, you can take a pick because there is no way of knowing which one's better or worse, right? I think I had a professor back in the day who said something I think is very, very true, which is as a founder, you're making a choice. Do you want to be rich or do you want to be king? And sometimes you could be both, but it's very unlikely, right? There are some founders who are very much like, I want to do things my way. I don't want people to tell me what to do. And those are the founders who will look for investors who will allow them to do that. And those are the founders who will also not want to take as much dilution to their ownership. And then there's founders who are like, I just want to be rich, so I don't care. If a VC is good at what they do and they're telling me here's what it takes for me to grow the business, I'm okay following that and being more of a cog in the wheel in some ways and being more diluted. But ultimately, maybe my company gets to a much larger scale than I would have been able to bring it to.
Cool. All right. Before we head on, I just wanted to ask two quick questions. How many of you guys are in town in SF because of the Databricks conference? Okay, so the rest of you guys are from San Francisco. Okay, interesting. And another question was, how did you guys hear about this event? Like online through the Luma or? Okay, sick. All right. Wait, can I get a show of hands on how many? Okay, so most of it's like Luma. Okay, interesting. I'm just trying to do a lot of marketing strategies for these events. Okay, cool. Well, thank you so much, Milly. Can I get a round of applause for Milly for the great panel? Thank you so much.
Thanks for having me.
Oh, all right.
Thank you. On me, give me a big smile, see you there. Hold on, ready?
Do you just want to get in the middle?
In the middle.
Yeah, you can say this.
All right, stay there. We do this one more time. Ready? One, stay there. One more. Thank you so much.
Okay, cool. All right. Thanks,
you.
guys. Thank you so much for coming. That's it.
Thank you.
As always. All right. Feel free to add me on LinkedIn or book a demo with us. What's up? Oh my God, I'm so sorry. I have one last, before everyone leaves, I have one public services announcement. Someone lost a wedding ring today. I'm gonna say that one more time because it's super important. Someone lost a wedding ring today in this space. If you guys can look down really quickly and see if you see anything like a wedding ring, it will be super duper helpful. Because I'm sure it's really important. Wedding ring, anyone find it? No? Don't take it. There's security cameras everywhere. Damn, okay. Well. Okay. No dice.